Hello everyone. Today we will do analysis of balance sheet of a company. The balance sheet equation. While the P&L statement gives us information pertaining to the profitability of the company, the balance sheet gives us information pertaining to the assets, liabilities and the shareholders' equity. The P&L statement, as you understood, discusses about the profitability for the financial year under consideration. Hence, it is good to say that the P&L statement is a standalone statement. The balance sheet, however, is prepared on a flow basis, meaning it has financial information pertaining to the company right from the time it was incorporated. Thus, while the P&L talks about how the company performed in a particular financial year, the balance sheet, on the other hand, discusses how the company has evolved financially over the years. Have a look at the balance sheet of Amara Raja Batteries Limited. As you can see, the balance sheet contains details about the assets, liabilities, and equity. We had discussed about the assets in the previous video. Assets, both tangible and intangible, are owned by the company. An asset is a resource controlled by the company and is expected to have an economic value in the future. Typical examples of assets include plants, machinery, cash, brands, patents, etc. Assets are of two types, current and non-current. We will discuss these in next video. Liability, on the other hand, represents the company's obligation. The obligation is taken up by the company because the company believes these obligations will provide economic value in the longer run. Liability, in simple word, is the loan that company has taken and it is therefore obligated to repay back. Typical examples of obligation include short-term borrowing, long-term borrowing, payments due, etc. Liabilities are two types, namely current and non-current. We will discuss about this kind of liabilities later in the video. In any typical balance sheet, the total assets of company should be equal to the total liabilities of the company. Hence, assets is equal to liabilities. The equation is called the balance sheet equation or the accounting equation. In fact, this equation depicts the key property of the balance sheet. That is, the balance sheet should always be balanced. In other words, the assets of the company should be equal to the liabilities of the company. This is because everything that a company owns has to be purchased either from owner's capital or liabilities. Owner's capital is the difference between the assets and liabilities. It is also called the shareholders' equity or the net worth. Representing this in the form of an equation, shareholders' equity is equal to assets minus liabilities. Note on shareholders' fund. As we know, the balance sheet has two main sections, that is, the assets and the liabilities. The liabilities, as you know, represent the obligation of the company. The shareholders' fund, which is integral to the liabilities side of the balance sheet, is highlighted in the snapshot. Many people find this term a little confusing. If you think about it, on one hand, we are discussing about liabilities, which represent the obligation of the company, and on the other hand, we are discussing the shareholders' fund, which represents the shareholders' wealth. This is quite counterintuitive, isn't it? How can liabilities and shareholders' fund appear on the liabilities side of balance sheet? After all, the shareholders' fund represents the funds belonging to its shareholders, which in the true sense is an asset and not really a liability. To make sense of this, you should change the perspective in which you look at company's financial statement. Think about the entire company as an individual whose sole job is run to its core operation and to create wealth to its shareholders. By thinking this way, you are in fact separating out the shareholders and the company. With this new perspective, now think about a financial statement. You will appreciate that the financial statement is a statement published by the company to communicate to the world about its financial well-being. This also means the shareholders' funds do not belong to the company as it rightfully belongs to the company's shareholders. Hence, from the company's perspective, the shareholders' funds are obligation payable to shareholders. Hence, this is shown on the liabilities side of the balance sheet. The liability side of balance sheet. The liabilities side of the balance sheet details out all the liabilities of the company. Within liabilities, there are three subsections: shareholders fund, non-current liabilities, and current liabilities. The first section is the shareholders fund. To understand share capital, think about a fictional company issuing shares for the first time. Imagine company ABC issues 1000 shares with each share having a face value of Rs 10. The share capital in this case would be 10 into 1000 is equal to 10,000. That is face value into number of shares. In the case of ARBL, the share capital is 17 crore rupees as published in the balance sheet and the face value is rupees 1. We can use the FV and share capital value to calculate the number of shares outstanding. Share capital is equal to FV into number of shares. Therefore, number of shares of ARBL is equal to 17 crore 8 lakh 10,000 shares. The next line item on the liability side of the balance sheet is the reserves and surplus. Reserves are usually money earmarked by the company for specific purposes. Surplus is where all the profits of the company reside. The reserves and surplus for ARBL stands at 1345 crore rupees. The reserves and surplus have an associated note number 3. Let us look into the same. As you can notice from the note, the company has earmarked funds across three kinds of reserves. Capital reserves, usually earmarked for long-term projects. Clearly, ARBL does not have much amount here. This amount belongs to shareholders but cannot be distributed to them. Securities premium reserve or account. This is where the premium over and above the face par value of the share sits. ARBL has 31 crores under this reserve. General reserve. This is where all the accumulated profits of the company which is not yet distributed to the shareholder reside. The company can use the money here as a buffer. As you can see, ARBL has 218 crore rupees in the general reserves. The next section deals with the surplus. As mentioned earlier, surplus holds the profits made during the year. Couple of interesting things to note. As per the last year, FY13 balance sheet, the surplus was 829 crore rupees. This is what is stated as the opening line under surplus. The current year FY14 profit of 367 crore rupees is added to the previous year's closing balance of surplus. Few things to take note here. Notice how the bottom line of P&L is interacting with the balance sheet. This highlights a very important fact: all the three financial statements are closely related. Notice how the previous year balance sheet number is added up to this year's number. This highlights the fact that the balance sheet is prepared on a flow basis, adding the carrying forward numbers year on year. Previous year's balance plus this year's profit adds up to 1197 crore rupees. The company can choose to use this money for various purposes. The first thing a company does is it transfers some money from surplus to general reserve so that it will come handy for future use. They have transferred close to 36 crores for this purpose. After transferring to general reserves, they have distributed 55 crores as dividends, over which they have to pay 9 crores as dividend distribution taxes. After making the necessary apportions, the company has 1095 crores as surplus as closing balance. This, as you may have guessed, will be the opening balance for the next year's FY15 surplus account. Total reserves and surplus is equal to capital reserve plus securities premium reserve plus general reserves plus surplus for the year. This stands at 1345 crores for the FY14 against 1042 crores for the FY13. The total shareholders fund is the sum of share capital and reserves and surplus. Since this amount on the liability side of the balance sheet represents the money belonging to shareholders. This is called the shareholders fund. Non-current liabilities. Non-current liabilities represent the long-term obligations which the company intends to settle off within 365 days of the balance sheet date. These obligations stay on the books for few years. Non-current liabilities are generally settled after 12 months after the reporting period. Here is the snapshot of non-current liabilities of Amar Raja Batteries Limited. The company has three types of non-current liabilities. Let's inspect each one of them. The long-term borrowing is the first line item with non-current liabilities. Long-term borrowing is one of the most important lines in the entire balance sheet as it represents the amount of money that the company has borrowed through various sources. Long-term borrowing is also one of the key inputs while calculating some of the financial ratios. Subsequently, in the fundamental analysis, we will look into financial ratios later. Let us look into the note associated with long-term borrowings. From the note, it is quite clear that the long-term borrowing is in the form of interest-free sales tax deferment. To understand what interest-free sales tax deferment really means, the company has explained just below the note. It appears to be some sort of tax incentive from the state government. The company plans to settle this amount over a period. The company plans to settle this amount over a period of 14 years. You will find that there are many companies which do not have long-term borrowings. While it is good to know that the company has no debt, you must also question as to why there is no debt. Is it because the banks are refusing to lend to the company, or is it because the company is not taking initiative to expand their business operations? Do recollect, we look at finance cost as a line item when we look at the P&L statement. If the debt of the company is high, then the finance cost will also be high. The next line item with non-current liability is deferred tax liability. The deferred tax liability is basically a provision for future tax payments. The company foresees a situation where it may have to pay additional taxes in the future. Hence, they set aside some funds for this purpose. Why do you think the company would put itself in a situation where it has to pay more taxes for the current year at some point in the future? Well, way, this happens because of the difference in the way depreciation is treated as per Companies Act and income tax. We will not get into this aspect as we will digress from our objective of becoming users of financial statements. But do remember, deferred tax liability arises due to the treatment of depreciation. The last line item within the non-current liability is the long-term provisions. Long-term provisions are usually money set aside for employee benefits such as gratuity, leave encashment, provident fund, etc. Current liabilities. Current liabilities are the company's obligations which are expected to be settled within 365 days. The term current is used to indicate that the obligation is going to be settled soon, within a year. Going by that, non-current clearly means obligation that extend beyond 365 days. Think about this way, if you buy a mobile phone on EMI, you obviously plan to repay your credit card company within a few months. This becomes your current liability. However, if you buy an apartment by seeking a 15-year home loan from a housing finance company, it becomes your non-current liability. Here is a snapshot of ARBL's current liabilities. As you can see, there are 4 line items within the current liabilities. The first one is the short-term borrowings. As the name suggests, these are short-term obligations of the company, usually undertaken by the company to meet day-to-day cash requirements, also called working capital requirements. Here is the extract of Note 7, which details what short-term borrowings mean. Clearly, as you can see, These are short-term loans available from the State Bank of India and Andhra Bank towards meeting the working capital requirements. It is interesting to note that the short-term borrowing is also kept at low level at just rupees 8 crores. The next line item is trade payable, also called accounts payable, which is at 127 crores. These are obligations payable to vendors who supply to the company. The vendors could be raw material suppliers, utility companies providing services, stationery companies, etc. Have a look at note 8, which gives the details. The next line item just says other current liabilities, which stands at 215 crores. Usually, other current liabilities are obligations associated with the statutory requirement and obligations that are not directly related to the operations of the company. Here is a note 9 associated with other current liabilities. The last line item in current liabilities is short-term provisions, which stands at 281 crores. Short-term provisions is quite similar to long-term provisions, both of which deals with setting aside funds for employee benefits such as gratuity, leave encashment, provident funds, etc. Interestingly, the note associated with short-term provisions and long-term provisions is the same. Have a look at the following. Since Note 6 is detailing both long-term and short-term provisions, it runs into several pages. Hence, for this reason, I will not present an extract of it. For those who are curious to look into the same, can refer to pages 80, 81, 82 and 83 in the FY14 annual report for Amma Raja Batteries Limited. However, from the user of a financial statement perspective, all you need to know is that these line items deal with employee and related benefits. Please note, one should always look at the associated note to run through the details. We have now looked through half of the balance sheet, which is broadly classified as the liabilities side of the balance sheet. Let us relook at the balance sheet once again to get a perspective. Clearly, total liability is equal to shareholders fund plus non-current liabilities plus current liabilities is equal to 1362 crores plus 143 plus 633. That is, total liability is equal to 2139 crores. In the next video, we will see asset side of balance sheet. Thank you for watching this video. Please do like, comment and share this video to your friends and relatives. Also don't forget to subscribe to my channel.